Not months, not weeks. In less than 48 hours, silver did something markets are not supposed to do quietly. It didn't just rise, it repriced, violently, across regions and across the plumbing that normally keeps price action contained. A metal that still gets treated like a side character printed triple-digit prices, then triggered the kind of exchange response that tends to appear only when risk managers decide the system is being tested. In one venue, futures settled near $115 an ounce. In another venue, real-world physical quotes were reported far higher, as if the world were trading two different silvers at the same time. It compresses months of positioning into hours. It forces leverage to show itself. It forces hedges to either bleed or breathe. It forces the clearing system to intervene, not by choosing a direction, but by changing the cost of staying in the game. People said a modern silver market could never behave like the old stories again. Yet here it is, moving fast enough to pull the past into the present, and doing it quickly enough that the normal explanations arrive late. The institutions that clear and warehouse this market respond first. By the time the public notices the candle, the collateral rules have already changed. Here is the pattern interrupt. Silver is acting industrial again, not as a slogan. In the way premiums appear, in the way geography matters, and in the way delivery mechanics suddenly become relevant. When silver trades like an industrial input, the repricing is the one no one wants, because it doesn't politely wait for forecasts. It doesn't pause for comfort. It doesn't follow the script that keeps participants feeling in control. It forces the market to admit that price is not a single number on a screen. It's a negotiation between paper and physical, between liquidity and logistics, between what can be promised and what can be delivered. Welcome to the Market Decode. Here, the focus isn't headlines, it's mechanics, filings, flows, and the market plumbing that moves before the crowd notices. If that sounds like the calm voice in the room that reads the fine print, stay close. And leave a comment with where you're watching from, because silver's story changes depending on which side of the globe is bidding for metal. Now let's reconstruct what happened, with the kind of detail that turns noise into signal. 0.8, an ounce after a 14% jump. That kind of move is not a gentle revaluation, it is a market teleport. The speed matters because silver is a leveraged market by design. Futures exposure is not a cash purchase. It is a commitment backed by margin. When price accelerates, clearinghouses don't debate narratives. They calculate potential losses under stress. Then they raise the collateral required to hold positions. Reports around this episode described margin requirements moving higher, toward roughly 11% of a notional value, the kind of shift that changes behavior immediately. At the same time, the market displayed something even more revealing than price: dislocation. In New York, price action clustered around $104 to $115. In China, reported trading and physical pricing ran above $140. That gap is not a rounding error. It is the difference between a paper reference and a physical urgency premium. Both statements cannot be true for long, because arbitrage normally squeezes gaps like that. When the gap persists, it suggests that the pipes between the pools are narrower than they look. And while that contradiction played out on screens, delivery mechanics kept turning. On January 30th, 2026, a metals delivery report showed 633 COMEX silver contracts moving through the issues and stops process. Each contract represents 5,000 ounces, 165 million ounces tied to a single day of delivery activity. In a market that is purely speculative, delivery is a sideshow. In a market that is being repriced because of real demand pressure, delivery becomes a signal because it shows participants willing to translate a paper obligation into metal settlement. This is the central mystery. A violent surge in futures, a regional premium that implies physical tightness, an exchange margin response that changes who can remain positioned, and a delivery tape that shows meaningful institutional participation. Silver is not merely moving, it is being negotiated between paper promises and physical necessity. To understand why this matters, silver has to be framed correctly. Gold is primarily held. Silver is primarily used. Yes, silver has monetary history, and yes, it often trades in sympathy with precious metal sentiment. Silver goes into solar panels, electronics, brazing alloys, chemical catalysts, and the circuitry that makes modern life function. Once it is dispersed into products, it does not casually return. That makes silver structurally different from a metal that can sit in a vault for decades without affecting anything else. The industrial angle is quietly rewriting the story. The solar sector alone has been cited as about 17% of global silver use. 5 million ounces in a recent survey year, the kind of number that should reframe what small market really means. 9 million ounces in 2024. Even if every ounce of that deficit is not felt immediately, the implication is clear. The market has been drawing on above-ground stocks to satisfy demand. Mine supply is not a simple dial that can be turned up on command. A large share of silver production is a byproduct of mining for other metals, which means higher silver prices do not instantly create new primary supply. Recycling helps, but much of the metal is dispersed in tiny amounts across electronics and panels, and that kind of recovery responds slowly and unevenly. When demand rises faster than those channels can respond, the market doesn't negotiate politely, it reprices. This is why the playbook repeats across decades. When silver starts behaving industrial, it moves through phases: quiet underpricing, tightening physical flow, widening premiums, and then a volatility event that forces the paper market to acknowledge the constraint. Each cycle looks different in headlines, but the mechanics rhyme. The market doesn't change because people suddenly agree on a narrative. It changes because the rules of participation, the availability of deliverable metal, and the urgency of procurement collide in a way that cannot be smoothed over. In 1979 and 1980, silver turned into a public obsession. Those years are often reduced to a morality tale about leverage and speculation, but the useful lesson is structural. When silver's price rises quickly, the system responds by changing collateral terms, which changes who is forced to sell and when. That response can turn a move into a cascade because a leveraged market is not just price discovery, it is a credit system. The price can rise because of buying, but it can also fall because collateral calls force liquidation. In 1985, silver produced another benchmark volatility moment. The catalysts differ across eras, but the pattern is consistent. When volatility hits extremes, the market's infrastructure reacts. Clearing members demand more collateral. Exchanges adjust requirements. Participants who relied on cheap leverage are pushed out. Price swings become less about fundamental consensus and more about who can survive the collateral regime. That is why biggest one-day move since 1985 is not trivia. It is a reminder that silver's most dramatic moves tend to be accompanied by rule changes, not just opinion changes. In 2011, silver ran toward $50 an ounce, and the inflection points again involved margin and positioning. As the rally intensified, margin requirements rose. Forced deleveraging followed. The price retraced sharply, but the deeper message was not that the industrial uses of silver vanished overnight. The message was that silver's real market includes a third actor, the clearing system's tolerance for risk. When that tolerance tightens, price action can whipsaw even if industrial demand and inventory trends remain unresolved beneath the surface. Now in 2026, the same structure is visible again, but with a twist. The industrial base is larger, the technological dependence is deeper, and the geographic flow is more complex. The modern supply chain is more interconnected, and it is less forgiving of missing inputs. The market is not simply asking whether silver is a store of value. It is asking whether the price being discovered in paper markets can remain disconnected from the operational reality of procurement. This is where it gets interesting. The public narrative loves simple binaries: inflation hedge or risk asset, money metal or industrial metal. Silver refuses to stay inside that box. It can behave like both, and the friction between those identities is exactly what creates the dislocation. When conditions are calm, silver often trades like a precious metal shadow, responding to rates, the dollar, and investor mood. When conditions tighten, silver trades like a critical input. Critical inputs do not politely respect a reference price if the reference price no longer clears real demand. So, who are the players shaping this repricing? Start with the exchange complex. The futures market concentrates price discovery into a standardized contract. That contract exists inside a clearing system. The clearing ecosystem is the gatekeeper of leverage. When volatility spikes, it adjusts collateral. A move toward roughly 11% initial margin changes the landscape overnight. It changes the cost of holding long exposure. It changes the ability of short positions to maintain exposure. It changes the financing math for dealers who hedge inventory. It forces a recalculation of risk for anyone who is not fully cash secured. Then there are the major clearing members and bullion banks, the firms that sit between buyers and sellers, manage warehouse relationships, finance inventory, and provide liquidity. These institutions appear repeatedly in delivery reports because they are infrastructure. They facilitate the flow between those who want exposure and those who want hedges. When delivery activity shows hundreds of contracts being issued and stopped in a single day, it suggests institutions are not merely spectators. They are actively managing obligations, inventories, and balance sheets through the delivery machinery. Next are the industrial users, the quiet giants who rarely appear in trading discourse. Solar manufacturers, electronics producers, and component suppliers do not care about chart patterns. They care about continuity. A small price change is a cost line. A violent repricing is a procurement event. If one region is paying above $140 while another prints $115, that implies someone is paying up to secure supply now rather than risk a production disruption later. In industrial logic, paying a premium can be cheaper than losing output because downtime is expensive and customers do not accept the commodity market was volatile as an excuse. Then comes the regional market structure. China's physical and exchange ecosystem can reflect local scarcity, import dynamics, and the simple fact that fabrication demand is concentrated. New York reflects futures liquidity, fund positioning, and the clearing structure that governs leverage. When those ecosystems disagree by that much, the disagreement is information. It hints that the global market is not one unified pool. It is several pools connected by pipes that can narrow when logistics tighten or when owners demand a higher price to part with metal. Now add vault reality. London vault totals are often cited in tons. One recent month-end figure sits around 27,118 tons of silver in London vaults, roughly 894 million ounces. That sounds enormous. It sounds like the market could never be tight. Metal can be owned long-term, pledged as collateral, leased, earmarked for industrial supply, or simply held because optionality has value. And available is not just a moral concept, it's a technical one. A bar in the wrong form is not a bar that can immediately solve a shortage. London's ecosystem centers on large good delivery bars, while exchange delivery in New York is tied to specific warehouse rules and bar standards. The futures contract is 5,000 ounces, but that doesn't mean a factory can simply call a broker and receive a perfectly sized feedstock shipment the next morning. This is also why the COMEX distinction between what is merely sitting in a vault and what is registered for delivery matters. Eligible metal can exist without being offered into the delivery system at current terms. Registered metal is the subset that is actually available to settle contracts. When volatility spikes, owners often become less willing to part with that subset, not because of drama, but because the value of optionality rises. That is how a market can show large headline inventories while still showing stress in spreads, premiums, and delivery behavior. This is how the dislocation forms. On one side is paper silver, futures, swaps, and unallocated accounts that reference silver price without requiring immediate physical movement. Paper is efficient and scalable. It allows hedging, speculation, and financing. It can expand and contract quickly. On the other side is physical silver, bars, coins, industrial feedstock, and deliverable inventory that must meet specific standards and sit in specific locations. Physical is not scalable in the short term. Mines do not triple output in a quarter. Refining capacity does not appear overnight. Logistics does not ignore shipping lanes, insurance, or customs. When physical tightens, it shows up as premiums, delays, and regional price gaps. The New York versus China gap is exactly that kind of signal. It suggests that local demand or local constraint is intense enough that buyers will pay far above the global reference. In commodity history, this is often where stress moves from abstract to operational because procurement departments start making decisions that charts cannot capture. But the data shows something else entirely. Even as paper prices whipped and headlines chased the move, delivery activity remained visible in standardized contract sizes. Hundreds of 5,000-ounce contracts moving through the delivery process indicate that at least some participants are willing to engage with settlement rather than treat silver purely as a financial token. Delivery is where a promise becomes a bar, and where a bar becomes a constraint if inventory is tight. When delivery stays active during volatility, it suggests the market is not only trading opinions, it is also managing real obligations. Now let's explain the mechanism, because in silver, the mechanism is the message. Picture the futures market like a bridge. Most days, the bridge carries traffic easily. Margin is the structural requirement that each participant has enough support to cross safely. When volatility spikes, inspectors raise the requirements. They demand more support per vehicle because the risk of an accident increases. That is not a judgment about direction. It is a judgment about stability. But raising requirements forces some vehicles off the bridge immediately. That exit is not a choice. It is the system enforcing physics. When silver surged, the margin toll rose. Traders holding leveraged exposure had to post more cash. Some could not. Those who could not were forced to reduce positions. If they were long, they sold to meet requirements. If they were short and the move was against them, they covered, buying into the rally. Either way, margin changes amplify volatility because they change the timing of transactions from discretionary to mandatory. In a market with a relatively small physical base compared to the size of financial flows, timing is everything. Now layer in hedgers. Physical dealers and industrial buyers use futures to lock costs and manage inventory risk. The goal is stability, not speculation. But margin is real cash flow. A hedge can be economically sound and still be financially painful if collateral calls arrive faster than the physical transaction settles. A sudden margin increase can turn an operational hedge into a liquidity headache. That is why real-world buyers can feel pain even when the long-term demand picture is strong. The market can punish the people who use it responsibly, simply because volatility forces cash to move faster than metal. This is the part that most commentary skips. Volatility is not merely a side effect. In constrained commodities, volatility can be a rationing device. When demand is strong and supply is tight, the market uses price and volatility to decide who can hold exposure and who must step away. Participants with strong balance sheets can absorb swings. Participants without that capacity must reduce activity. Over time, that pushes price toward a level where demand is either reduced, supply is incentivized, or substitution begins at the margin. Historically, this process is rarely linear. It comes in waves. First, a shock move that wakes everyone up. Then, a pullback driven by margin and positioning. Then, a grind as physical demand continues to pull. Then, another shock when the paper market hits the boundary again. The key is that each wave leaves a trace in the plumbing. Changes in open interest, margin, adjustments, delivery patterns, and the persistence of regional spreads. Those traces are the real narrative. The headlines are the afterimage. So what does this mean going forward without pretending to predict a precise path? If industrial demand remains elevated and if deficits represent real ongoing drawdowns, the silver market will remain sensitive to disruptions. In that environment, three broad scenarios tend to appear. A conservative scenario looks like this. Volatility cools, margins stabilize, and prices consolidate while physical premiums work through the system. The chart looks calmer. The headlines move on. But the underlying tension remains, expressed quietly in regional spreads, procurement behavior, and the cadence of delivery. The market feels boring while the constraint quietly persists. A moderate scenario looks like this. The dislocation persists. Prices see intermittent spikes as paper liquidity collides with physical urgency. Premiums and spreads become the real story because they reveal where the metal is tight. The market repeatedly tests the willingness of participants to warehouse risk at prevailing prices. The tug of war continues, not as a debate, but as a series of cash flows and shipment decisions. The market stays loud in its plumbing even when the chart tries to calm down. An aggressive scenario looks like this. A new shock forces a wider repricing of the global reference, not because of a mood swing, but because industrial procurement refuses to accept the paper discount. In that scenario, what matters most is how the regional gap closes. A tightening market often closes gaps by lifting the cheapest venue upward rather than dragging the expensive venue down. That is how scarcity expresses itself when the marginal buyer is operational rather than speculative. It is not a forecast. It is the way constrained markets have historically reconciled disagreement between paper reference and physical urgency. The indicators to watch are mechanical, not mystical. Watch for repeated margin changes and the effect on open interest. Open interest can fall when leverage is flushed and can rise when new participants step in. Watch delivery activity in standardized sizes because delivery is where paper meets physical. Watch regional premiums and persistent spreads because they reveal where metal is scarce relative to demand. And watch industrial consumption trends, especially in sectors like solar, because that demand is not easily deferred without real economic cost. Now we arrive at the divide. There are two ways to experience a market like this. One way is to watch the chart and feel every candle. The other way is to watch the constraints and treat the chart as a lagging representation of a negotiation that is already underway. The difference is not about being smarter. It is about looking at the right layer. Silver's layer is not just price. It is the collateral regime, the delivery mechanics, the premiums that show what the real economy is paying, and the regional spreads that show where the metal is struggling to flow. In episodes like this, institutions tend to move first because their mandate is to manage risk, not to debate narratives. They respond to margin rules, delivery mechanics, and procurement realities long before the public story catches up. Retail attention typically arrives later, often when the move is already famous. And when the move becomes famous, the system often tightens conditions because it must manage stability. That is why the repricing no one wants is also the repricing that keeps returning when silver starts acting like an industrial input instead of a quiet financial symbol. Silver acting industrial again means the market is not simply asking what investors believe. It is asking what factories require, what electrification consumes, and what supply chains can tolerate. Those questions are answered not with opinions, but with flows, premiums, and the paperwork of delivery. When those signals contradict the easy narrative, the contradiction is not confusion. It is the market revealing a boundary. This is the market decode, where we connect the dots before they become the story everyone repeats. If this tied together details that felt disconnected, the next step is simple. Keep watching the mechanics, not just the chart, because the question isn't whether silver can be volatile. The question is whether the next wave arrives, while most attention is still focused on the wrong signal.